Hi everybody, how you doing? David here. Hope everybody's well. Happy New Year. Was trying to get this out to you sooner, but wanted to give you some of my thoughts about really 2022 and some of the challenges that we're facing with the economy and things like that can affect portfolios. You know, every year has its own challenges. We came from COVID in 2020, the COVID crash, I call it. And now, you know, going through that, all the stimulus that happened, all the interest rates falling, the things that were done to help to push forward the economy, which I think were needed for sure. But we're in a totally different world now. First off, you know, inflation. And inflation is probably the biggest question I get asked about every day by clients on review meetings or just talking on the street, so to speak, or new clients. In inflation, we definitely have inflation. It's a new kind of fly in the ointment, so to speak, relative to markets. We've not had really real inflation since, you know, really the 80s. Right now, CPI is running about 7%. I would argue it's probably closer to 12. If you look at the way historically that the government used to calculate the CPI index, it would be about 12%. So I'm sure you can figure out on your own between food and gas and things like that cost of goods are probably more than 7% and rising. So that's a real issue. And so that's a headwind that we have. Where does it impact? What are the opportunities there? You know, definitely in the bond market. I mean, right now we have what's called negative interest rates. We have rates that are inflation adjusted. If inflation is running 7 and you have short-term rates running 1%, you basically have a 5 or 6% negative interest rate. We've not had this type of marketplace since really 1980 when inflation was running 14, 15% and you had short-term rates in the 9, 10% range. You had basically like a negative 5% real yield. So, you know, it's a tough market for the bond market. Any type of income type instruments are going to have some issues. But the key is, you know, when do we kind of go from the Federal Reserve, which we'll talk about next, which is looking at tightening right now, meaning they want to raise interest rates. Chairman Powell just last couple weeks ago said that he wants to raise rates, or they've talked in their notes, you know, 3 to 5 times over the next year. That may sound like a lot, which it is, but you got to remember we're starting from zero interest rates. I mean, basically rates are zero when it comes to the federal funds rate. So even if you have 5 rate hikes, you're talking about, you know, 1.5% in that range relative to maximum hikes. Now going from 0, 1.5 exponentially is a lot when you're starting from 0. But you're probably not talking 3, 4, 5, 6% rates. It's just probably not going to happen, especially since, you know, we're so indebted now. We're really almost a debtor nation at this point in time, and that's just an expense to the balance sheet of the federal government. So it's going to be difficult for them to do this. On top of that, you really have an economy that's going to be slowing. You know, we don't have a lot of stimulus. We don't have the stimulus that we had. Stimulus meaning all of the, you know, the direct deposits to people's checking accounts, all the federal stimulus, all the monetary stimulus, all of the fiscal stimulus. I think I calculated roughly, I think we had $10 trillion over the last 2 years in stimulus between monetary stimulus with the Federal Reserve printing money and actual Congress, you know, doling out money. To give you an idea, during the financial crisis, there was less than $2 trillion that was spent in combination between fiscal and monetary policy. So you're talking about 5 times the amount of money that was pumped into the system. And liquidity drives markets. And so when you have liquidity like that, it's going to help to prop up asset values. We've all seen that in our retirement accounts going up. We've seen that in our real estate going up. And so, you know, that will only go so far. And the economy really is going to have to catch up to the stimulus. So the challenge the Fed's going to have is raising rates into what I consider, a lot of people smarter than me, really a slowing economy that there's no tailwind behind. So it just creates a little more difficult environment. But there's a saying that the market always climbs a wall of worry. There's always something to worry about. You know, we have the issue with Russia and Ukraine again right now. Who knows what's going to happen with that? It's already affected oil prices. Gas prices have gone up just on the hint of that happening. And so there's always things to worry about. You know, again, no more stimulus we talked about. Market valuations. You know, market valuations are high. I mean, they're in levels where we have not seen since the 2000s. They've come off a bit with this recent market volatility. Market valuations are not market timing vehicles. So, you know, the fact that they're high, you know, they're always high when relative to when you have bullish markets that are going higher. But market valuations are definitely on the higher and extreme side. Again, have come off a little bit. And then looking further down the road, midterm elections. That's going to be an issue. Not talking politics here, but depending upon what side of the aisle somebody's on, there's going to be some changes most likely. Just historically, when you have a Democratic president, you're typically going to have a split Congress and Senate, or maybe both. Right now, of course, the Democrats control all three. And so we'll see how that shakes out. The things I'm keeping my eye on. I typically do a midterm election cycle type of talk, so I will talk more about that kind of prior and maybe after that happens. But on the positive side is that hopefully Omicron has run its course. I look statistically from looking to Europe and to South Africa. We're probably at the peak of Omicron right now. Of course, there's always another variant around the corner, but a lot of epidemiologists I follow and read about, they said if they were going to build, a way to inoculate the world, it would be Omicron relative to death rates and the severity to give everybody be infected. It will help hopefully going forward get us out of the pandemic mode that we're in right now. So that will be almost like a reopening trade if we can get that to happen and we don't have the same kind of shutdowns of societies that we've had across the world. So on a positive side, I think that could be, if we're on the other side of the pandemic, I think that's definitely a positive for the markets. But it's definitely challenging right now. So I just want to give you my thoughts. I'll do more of these sooner than later, I promise. And if you want to reach out and speak with me, please do. But otherwise, take care and look forward to talking to you.